Are you trying to apply for a business loan? Not sure where to apply or what to apply for? Well, in this video, we're going to talk about the main types of business loans. My name is Ryan, I'm an SBDC advisor, and I'll be your host. At some point of the growth of any business, a business loan is required. Now, most of us are used to consumer loans like credit cards and mortgages, car loans, but the application process and the information that's needed is completely different. So the purpose of this video again is to help you understand what they are so you can better prepare for it and get better results. Now, all business loans are always made to a business entity, such as an LLC or an S-Corp, but they're guaranteed by the owners of the business. As a result, information for both the business owner and the business are required. Now, sometimes a business can be guaranteed, or a business loan can be guaranteed by just the business. Those are called non-recourse loans, but that's the exception and not the rule. So commercial loans will always mirror the useful life of the asset that's used to guarantee that loan. For example, a building might have a useful life of up 20 years, 25 years or greater, so it could be amortized over a longer period of time. A shorter term asset such as a car or machinery could be maybe 5 or 7 years. So the loan can only be amortized for up to 5 or 7 years. Another difference between a business loan and a consumer loan is that the rates are always tied to a base rate. And most common one would be, let's say, the prime rate. And depending on the credit environment and the risk of the overall package that you present to the lender, your rates could be somewhere as low as 2%, as high as 7% for most business loans. Now keep in mind, this doesn't apply to all of them. There are some loans such as hard money loans, factoring, cash advances, where those rates could be much, much higher. And there's also specialty programs at your local community that could be even lower or no interest at all. So remember, there are different types of loans, but usually they're factored down to about 3 basic types. The first type is a commercial mortgage. Now, the purpose of this one is to buy commercial real estate. Usually with conventional commercial mortgages, it's around 20% down, and it's a little bit higher, the down payment, if it's a special use property. A special use property is a property that has characteristics that are designed for a particular use, such as a gas station or a bowling alley. Something else that's useful about commercial mortgages is that they're amortized over a longer period of time, generally between 10, 20, 25 years. It all depends on the type of property that it is. And the rates are usually fixed for about 5 or 10 years, and then will reset at the current rate at that time. Another type of business loan is a commercial term loan. These are used to purchase equipment, purchase commercial vehicles, leasehold improvements, etc. Now, these are usually secured by that equipment that we're buying or by that asset that we're buying. Because the equipment, as compared to, let's say, real estate, depreciates faster, the loan is going to be over a shorter period of time. So we usually amortize those between 5 to about 10 years. The down payment, because the asset depreciates quicker, is also going to be a little bit higher. Again, depending on the asset, could be between 30 to 40%. And the rates are usually also a little bit higher, again, because of the type of collateral that's used to pledge the guarantee. So the last category is the commercial line of credit. These guys work a lot like a credit card. They're used to fund the gaps in a business's cash cycle. Generally, they're given out in about 12-month intervals, and they're either secured or unsecured, depending on the business. If they're secured, they're collateralized with the lien against the real estate or a UCC filing against the business assets. Businesses will draw down on the line of credit when waiting on payments, let's say from a government contract or an account receivable. Now, seasonal businesses will use these in order to support themselves during the off-season. Lines of credit are expected to revolve in accordance with the cash cycle and should not stay drawn for more than 12 months. Payments are made usually with interest only, and the principal payment will be made in accordance with the business's cash cycle. At the end of a 12-month period, the bank will review the financials and then automatically renew it for another 12 months. Lastly, before we finish, it's important to remember these are the basic types of loans. There's many other variants. Some of the variants are designed specifically for your business, for your industry, for the age of your business, and so it's best to talk to a financial advisor, an SBDC consultant, who will tell you these are the best products for you and the best version of that product for you. Now, it's also important to remember that banks are required to monitor their portfolio. The way they do that is by asking you guys for updated financial statements throughout the life of the loan. That could be quarterly statements, that could be annual tax returns, that could be month bank statements. So a lot of it depends, again, on the type of loan that you have, on the type of relationship that you have with the lender, and what your needs are at the end and the goals are. So how do I start? Well, the first part is watch these videos. The second part is contact the SBDC. Somebody there will be able to guide you through the process, find out what the right one is for you, and then get you going. So I hope this video was helpful and get you on the right track to business financing.